This is PGI. Please stand by. We are about to begin. Good day, everyone, and welcome to the Wellington Drive Technologies results call. Today's call is being recorded. At this time, for opening remarks, I would like to turn the conference over to your moderator today, Mr. Howard Milliner, Chief Financial Officer. Please go ahead, sir.
Thank you, and good morning, and welcome to Wellington's first half 2013 results conference call. On this call today, we'll be discussing forward-looking statements. As these forward-looking statements are predictive in nature, they are subject to a number of risks and uncertainties relating to Wellington, its operations, the market in which it competes, and other factors, some of which are beyond the control of Wellington. Actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. I will discuss our key financials for the first half of 2013 and any guidance for the 2013 financial year, and then Greg Allen will comment on our turnaround progress and strategic updates. We'll take questions. Please limit your questions to one question and one follow-up question. Greg and I can be reached after the call for any additional questions you may have. A key strategic objective for the company this year is to achieve a substantial improvement in gross margin performance. In the first half, our gross margin percentage was 17% of revenue, which is an improvement over the 12.3% for the same period last year, and on track to achieve guidance of 18 to 20% for the full year. The improvement reflects a successful start to our supplier cost reduction program and the resolution of problem inventories last year, which means we had and have less risk of surprise write-offs. We expect to see further gross margin improvements in the second half as lower pricing from our contract manufacturer feeds into cost of goods sold. There are initiatives underway to further improve margins for financial year 14. Revenues for the first half of 2013 were $16.4 million. Excluding ventilation motors, a business that we decided to exit last year, commercial refrigeration volume at 655,000 motors for the half was 4% higher than for the same period last year. Revenue growth in the Americas was 13% and in Europe 18%, albeit from a low base. Performance in the Asian market has been disappointing, largely due to a lack of investment because Wellington did not have the financial resources. This lack of investment has been addressed now by the appointment of a new business development executive in China. Operating expenditure of $4.4 million was $500,000 lower than the first half last year. Cost reduction remains a focus, and there are further cost savings to secure, but we have started to invest in people to drive our growth in 2014 and subsequent years. The company's EBITDA performance for the period was a loss of $1.471 million, a significant improvement over the previous year's first half loss of $1.822 million. At an EBIT level, the first half loss was $1.739 million compared to $3.271 million for the same period last year, a 47% improvement. The company recorded a maiden profit for the June month. Whilst modest in amount, it was a milestone to be celebrated. The inventory turn at June 13 was 5.5 times on a 12-month rolling basis, and we're targeting 7 times by year end. This result shows a continuation of our good work managing inventory levels. We will be implementing some new regional inventory in the second half to improve our ability to meet customer demand and also to maintain the business through the Chinese New Year. Our balance sheet at 30 June is strong, largely as a result of the 4.4 million share capital issue early in the year. At balance date, we had 5.4 million in the bank and no bank debt. Operating cash flows for the first half was an inflow of 0.5 million as a result of lower working capital in the business. In summary, motor volume for the first half was up 4%. Gross margin as a percentage of revenue is up 3.7%. Operating costs are down 11%, all very positive trends. Our revenue outlook for 2013 continues to be in the range of 30 to 33 million, and our gross margin expectations are on track to previous guidance of 18 to 20%. We continue to expect an EBITDA loss of less than 3 million this year and break even or better result next year. This is consistent with previous guidance and assumes an 80-cent US exchange rate. At this point, I'll hand over the call to Greg Allen.
Thanks, Howard. Hi, everyone, and thanks for calling in today. I'm pleased to be able to talk to you about the progress we are making in our continuous improvement journey today. Our turnaround plan is over halfway through, and I hope you can all see genuine progress has been made on a number of fronts. We are talking more about the new Wellington, one that stands for reliable products, personal customer service, a relentless focus on results, and intelligent solutions for our customers. Firstly, our efforts on gross margin expansion, which Howard has already touched on, are really starting to take hold, with 17% achieved in the first half, a record number for the company. Our cost reduction programs are moving ahead well, and we are seeing some of the benefits of these programs in our numbers. But we still do have several cost reduction projects underway, and some are taking longer than we expect to complete. We do expect the completion of the bulk of our cost reduction programs over the next 6 to 9 months. The encouraging part is we see more opportunity to improve here going forward, and cost reduction will be an ongoing long-term focus for us, so it will never stop. On the product strategy and growth front, we completed our new fan pack product in the first half of this year and are releasing this product to the market in coming weeks. In fact, the first release products have already been sent to our launch customers. This fan pack solution allows our motors to be used in the supermarket application, which is a key growth market opportunity for our business and one we intend to focus on over the next 18 months. Over a year ago now, and as part of our Lean Business Improvement Program, we implemented what's called an agile product development process to help ensure the success of how we commercialize our new solutions. Agile is a lean business approach taken from the software industry that improves the effectiveness of product development by driving rapid change and iteration of solutions and getting those solutions in customer hands fast to get the feedback from the customers and build it into new offerings. It really does underpin our voice of the customer business model, where all of our growth programs are focused on solving customer problems. Our new customer development activities continue to produce results, and our business teams in the field are very focused on building best-in-industry relationships with customers. Europe was a strong point for the half, with our commercial refrigeration revenues in that region growing 18% versus the same period in 2012. This is a direct result of new customer wins from last year starting to ship to revenue. We believe our new customer development plans in this region will help offset what we see as continued recessionary environment in the Europe market. Our Latin American market grew by 15% year over year, as we saw strength in countries like Colombia, a new market for us, and of course Mexico, where we have a market-leading position. We are grateful to our customers in this region for their business and continued partnership. As Howard mentioned, in the Asia-Pacific region, we have recently hired a new executive. He is based in Shanghai, China, and in charge of sales and marketing for that region. This is the first business development investment we have made in the Asia-Pacific market for many years, and one which we intend to build on as we look to return our APAC business to growth. We continue to work on our 5 main priorities. This is how our team spends its day. Just a brief summary on progress here. The first priority, market expansion. Our intelligent solutions portfolio is well underway, and we have working software and hardware models in our design area. Our marketing of these products is focused on both global brands and OEMs, and we are confident we are seeing genuine demand for these new solutions. Our second priority is shortening customer lead times. This is a task that's proving harder than we thought, with slower progress this year than planned, mainly because of how hard it is becoming to re-engineer our component manufacturing supply lines. Specifically in this case, our cable manufacturing lead time project is running late. We think this goal will likely slip into the first quarter of next year, but will still be closed. The third priority is our cost reduction focus. This is going quite well, with great support from our supplier partners on delivering cost improvement this year. There are a few projects focused on component cost reduction that are running slower than we would like, and we may not see the benefit until early 2014. However, we still feel like we will hit our cost reduction objectives this year. We did complete the change of commercial terms with one of our primary partners, talked about in previous releases, and that will deliver cost reductions starting Q3 2013. We continue to look at alternate supply chain strategies with a view to continue to lower our supply chain costs and put in place a long-term growth capacity. The fourth priority, our strategic partner program. This project is progressing well, and we have several discussions happening with a short list of targets that should be able to add value across the areas of supply chain, technology, or market collaboration. Our strategic partner plans are on track to be completed by the end of this year. And finally, strengthening company resources. We are very thankful to our shareholders for backing us earlier this year with a successful capital raising of $4.5 million. This capital has helped us support a number of turnaround initiatives and start to invest in future growth. In the first half, we added a new general manager for our Intelligent Solutions business. We've continued to invest in highly skilled software and hardware engineers to increase our bandwidth on these Intelligent Solutions products. And as I mentioned, we're starting to invest again in the Asia-Pacific region. In closing, our first half was a good indicator that our turnaround plan is well on its way to achieving its objectives. Our midterm goal of 25% gross margin doesn't seem that far away now, and I couldn't have said that when I joined the company 2 years ago and had to talk about 4% gross margins. Our attention has turned to growth opportunities in 2014 with solid new customer momentum, the launch of our first supermarket-focused product, and several new geographic market opportunities we are exploring. Of course, we are not getting so far ahead of ourselves that we forget about maintaining the operational excellence culture we are building, and no doubt the world economy still holds some surprises that will challenge us. But as our cost reduction program continues, we believe that our execution model can start to support increased growth. Our commitment remains to deliver a positive EBITDA next year in 2014 with continued new customer and new product momentum to ensure our long-term growth is set up for success. Thanks, everyone. Thanks, operator. If we could go to Q&A now.
Thank you. The question and answer session will be conducted electronically. If you wish to ask a question, please press star 1 on your telephone keypad and wait for your name to be announced. If you're on a speakerphone, please be sure your mute function is turned off to allow your signal to reach our equipment. Once again, that's star 1 to ask a question. We'll now pause a moment to assemble a queue. Your first question comes from the line of Roger Armstrong from Aspiring Asset Management. Your line is open. Please go ahead.
Hi, Greg.
Hi, Roger.
You'll be glad to have me back, so someone answering questions on your call. In the first quarter, you declared gross margins are pretty close to 17%, and in the second quarter you've done the same. Although you did note that June was 21%. So do I take it from that you actually haven't, that if you did get any reductions from changing your payment terms that happened in June, or that it didn't happen at all in this half?
Yeah, good question, Roger. Thanks for that. We've still got some of the benefit of that cost reduction from the payment terms change to flow in second half. So yeah, you can take. I think that's right. We didn't get it all in Q3. Just timing. So there's going to be some incremental benefit from that in the second half. Right.
And from the other major part of your cost reduction program, the playing around, getting perhaps new or better terms from your electronics suppliers and other suppliers, when will that be likely to kick in?
The cost reduction we've seen this year, and as I mentioned with that change in terms flowing in second half, we don't expect that. I mean, that's not it. There's more cost reduction opportunity that we're seeing ahead of us, possibly at the end of fourth quarter, but more than likely as we go into next year, Roger. First quarter, second quarter is when it really starts to, when the next tranche starts to come about. So that would be our expectation now.
Right. Okay. And growth, just 4.7%. Given the products you have and new relationships, it just doesn't seem a lot. I mean, how do you go from there to growing at 15% per annum or more?
Yeah, that's we're pretty pleased with the new customer wins that we've had. And I think if I take you back to last year when Europe was looking really horrible, we said we'd go out and win some new customers in Europe. We did, and those new customers have delivered 18% year-over-year growth on our existing products. We just launched our new FanPack. We've still got new products to launch first half of next year. So we're pretty satisfied with the new customer wins we've got. The sales cycle on some of those new customers, it can be as much as a year to get new revenue shipping, and we've just started to see last year's wins coming online now. So new existing products, I think, between the 5, 6, 7% growth on those existing products, and when our new products start to kick in next year, Roger, I think that's what takes us up to the north of 10%, 10 to 15% growth.
Right. And just finally on that, what you call a FanPack product, I mean, this company has always in the past talked as if it was already selling into places like Tesco's and Kroger's and things. What's the difference?
I would, this FanPack product is a fully integrated airflow solution that really gets integrated with our existing ECR01 motor. It's also a solution that can be integrated with our new motor products. I would just, I'd be open with you. In the past, I think supermarket has been a bit of a hobby, meaning in the past. For the last year, it's been a strategic focus. So we have been out there actively marketing and selling to OEMs who build the product for these supermarkets, and we've been designing products focused on what they're telling us their problems are and what they need. So it's not, entering that market is very strategic for us now. It's part of a diversification strategy to expand our business outside bottle coolers. So it's, I think we're just going to gain more and more traction, and we're winning customers every quarter in this space.
Right. Thank you very much. I'll see if there's anyone hanging around to ask other questions.
Thanks, Roger. Good questions.
Your next question comes from the line of John McMahon from Oro Investment Management. Please go ahead.
Hey, John. Oh, I've lost John.
Ms. McMahon, your line is open to ask a question. You may have us muted.
Are you there?
Yes, can hear you, John. How are you?
Yeah, good, thanks. Just on receivables, if I look at sort of the ratio of receivables to sales, this half seems to have run a little bit rich. If I apply sort of metrics from the last couple of years, it looks like there's maybe an extra couple of million sitting in there. Is that just a timing issue, or is there anything that's structurally changed about your receivables?
A bit of both, really, John. June was a record sales month for us, so that is part of the reason why debtors are higher at June than they were at December. But we are also seeing some extension of payment terms from customers. We've been under pressure really all year from customers looking to extend either from 60 days to 90 days or 30 days to 60 days. And while we're fighting it, it has inevitably led to an extension of terms. So I think we've gone from about 49 days on average that we planned this year to between 60 and 65 days.
Okay, so some of that will come back in, but not much of it.
Correct.
Yeah. Okay, and the second question is, I noticed you mentioned in your outlook comment the company continues to see increased competitive cost pressures from both existing and new competition. What's sort of the risk of competitors starting to erode away some of the gross margin gains that you are putting in place?
Yeah, John, I think there is some risk. I mean, just to give you more color on that dynamic, the competitors, the Western competitors, let's say, the ones based in the US and Europe, we're competing very well with those companies. They're very strong companies. We have a lot of respect for them. We've got some great products out there, so we win some customers, they win some customers. I mean, it really is quite a balanced market. We are seeing some new entrants coming from Asia that are competing quite differently in the low end, I would say, of the market. And we're responding to those, and we're finding that the reliability of our products, the relationships we have with our customers, and just the length of time it takes to qualify new products in the commercial refrigeration market is really helping us compete. But we're not complacent. I think over the long term, price will become more prevalent than it is now in that market. So our cost reduction plan next year, I think we're being pretty honest with ourselves about how much we may have to give away to price and how much we can retain to compete. We won't do that in every case because I think, we're pretty selective with which customers we want to take that approach on. The other thing is our new products, our new motors specifically, which we're planning on bring to market next year, are being designed around a lower cost structure, both supply chain and product. So that gives us some more headroom as well to compete on price if we needed to. And we don't need to in every customer for sure, but we just want to be smarter around how we do that and give ourselves the opportunity to compete on price where we need to.
Okay, thanks, guys.
With no further questions in queue, as a reminder, if you would like to ask a question, please press *1 on your telephone keypad. We have a question come through from the line of Richard Burton from Forsyth Barr. Please go ahead.
Hi, Richard.
How are you doing? Now, my question was, you issued some partly paid shares during the year, and the 16.5 cents didn't seem to be a high hurdle for, 2016. And I also wondered, the distribution of them wasn't very even. I just wondered if you'd comment on that.
Yeah, happy to, Richard. One of the things that the board has been starting to focus on this year is just making sure we're, the retention and recognition program for key executives and key skills, that we kind of relaunched that. It hasn't been active for the last 2 or 3 years, I guess, with the exception of myself. I mean, everyone, I think it's public knowledge that, when I joined, I had some partly paid program that was committed to me. But for the other executives and key skills in the business, it really wasn't a program that was being maintained. So I asked the board to reconsider that approach, which they did earlier this year. And, the board went through an assessment of those key skills and key management and came to those that distribution that you mentioned. In terms of the exact details of how each individual distribution was worked out, I mean, I'd rather not go into that on the call. I'm happy for that to be a conversation that if you wanted to, have that conversation with one of the board members, Richard, I'm happy to do that. Just from an individual conversation point of view, I don't think that's appropriate. But we are continuing to look at how we retain our key skills and key people. And I think, there's a process around how the board are looking at that, and I think that's pretty much how I'd explain it without going into each individual situation.
Thank you.
And we have a follow-up question from the line of Roger Armstrong from Aspiring Asset Management. Please go ahead.
Oh, hi, Greg. I'd just like to say how enormously pleased I was when the company raised money to see the breadth of money put in by a variety of executives paying real money for their shares, and it was a breath of fresh air in terms of the listed market, and gave me a lot of confidence in in how the people inside the company saw things ahead. So,
look, I appreciate that comment, Roger, and I hope executives and employees keep thinking that way going forward.
Yep. I hope we all do.
And there are no further questions at this time, gentlemen. I'll hand the call back to yourselves for any additional closing remarks.
Thanks, team, for joining in, and great questions. I am available on my cell phone, and so is Howard after this call. My cell number is 027 777 9025, in case you haven't got it. Maybe be seeing some of you this week, but feel free to call Howard and myself as well. And again, we're really pleased with the first half results, but we're not complacent. We've got a lot more stuff to work on, and there's a lot of actions in play here that we hope will continue to show financial improvement over the next 6 to 12 months. So thanks for your support, everyone. Really appreciate it.
And this does conclude our conference for today. Thank you for participating. You may all disconnect.